Taking out a bank loan, using a credit card, or some other type of debt is not always a bad idea, but it's important to understand the risks and benefits of using debt before you approach the bank. Individuals and companies typically use loans, mortgages, and credit cards to buy things they cannot afford using their own money. In exchange for lending the money, banks and other loan providers expect the loan to be repaid in full. They will usually create a payment plan at the beginning of the loan, requiring you to make regular repayments. In addition to the loan amount, banks also charge interest. This can be a fixed amount like 5% interest for 2 years, or variable where the interest rate can change each month. If the bank thinks you are a riskier borrower, chances are they will ask you to pay a higher interest rate. When you are applying for a loan, you should always look at the comparison rate. The comparison interest rate includes all the fees and charges, making it easier to compare different loans. Because it includes all the fees and charges, the comparison rate is often higher than the interest rate in marketing documents. If a loan is not repaid by the due date, or you miss a few repayments, you may face penalties, including receiving a poor credit rating or court action. Using a loan could be a good idea when the item you buy goes up in value, like a house, or if the interest is tax deductible. But just remember, the bank is pocketing the interest you pay on the debt. Using credit cards or loans might be a bad idea when you use the money to buy things you don't need, like clothes or a television. Using a loan might also be a bad idea when the item you buy falls in value over time. Finally, debt might also be a bad idea when you cannot afford to make the minimum interest repayments. When you apply for a new loan, you should be honest with the lender about your income and expenses, because if they think you cannot afford to borrow the money, chances are you cannot afford it. One way many people minimize their debt is by creating a budget and identifying all the loans they need to repay. Then, they choose to pay the loan with the highest interest rate or the loan with the smallest amount remaining. Borrowers may be able to do this by making extra repayments, having a garage sale and using the proceeds to pay off a loan, or rolling 2 or more debts into another loan with a lower interest rate. If you find yourself with too much debt, you should visit the National Debt Helpline website and make a free call to one of their financial counsellors before taking any action. They can help you come up with a plan to tackle your debts, and best of all, it's free.